In terms of economics, inflation refers to general increases in the money supply, money incomes, or money prices. Generally speaking, inflation is understood to be an excessive rise in the overall level of prices. In today's video, we will be discussing the various aspects of the current economic inflation in the US. At Finance Doc, we will be sharing more explanation videos related to cryptocurrencies, trading, forex, and many more. So watch this video till the end and hit the subscribe button. And click on the bell icon to get notifications for our future videos. So let's begin the video. What are the economic impacts of rising prices? The American people are now suffering from increasing prices following a challenging couple of years. Fuel prices, power costs, weekly shopping costs, and other expenses are rising sharply, impacting consumer budgets just as they get ready to spend a lot during the holiday season. The Bureau of Labor Statistics, BLS, reported that consumer prices increased 6.2% over the previous year and 0.9% in October. This number is significantly higher than the Federal Reserve's target inflation rate of 2%, and represents the highest yearly increase since December 1990. What is causing today's inflation? Most economists attribute price increases to COVID-19. Pent-up demand was created at a time when supply chain bottlenecks were common as people were anxious to take advantage of their freedom and spend some of the money they hadn't used while being imprisoned at home. The epidemic has reduced production of many kinds of goods and services, and businesses are currently either working to make up lost revenue or attempting to resume normal operations. In general, the virus had the opposite impact on demand. A drive to consume, travel, and buy was sparked by government stimulus packages, a lack of spending because of being compelled to stay at home, and a desire to enjoy life again after a stressful few years. In other words, the combination of high demand and inadequate supply is what is causing prices to soar. Which prices are rising highest? Almost every industry was impacted by COVID-19, which changed how much we pay for anything from a gallon of gas to a loaf of bread to a pack of bacon. The BLS always includes a breakdown of price changes by category with each announcement of its monthly inflation numbers. The largest annual price increases for fuel, auto rentals, gas utilities, and used cars and trucks were noted in October. Will inflation ease in 2022? Whether this rate of price increases will continue is the topic of greatest discussion right now, at least in economics. Numerous analysts are certain that the current inflationary pressures are short-lived and will soon subside. Others are less optimistic, contending that Americans, and people in the majority of the other largest countries in the world, need to adjust and be ready for greater adversity. According to one widely accepted idea, the current concentration of price hikes should be resolved as soon as supply chain constraints and the demand to purchase these items, following the lockdown, diminish. In the past, when a small number of goods and services caused high inflation numbers, it didn't take long for prices to return to normal. There are additional grounds for thinking that the current demand may wane. Households' pandemic-related savings hoards should eventually be depleted, and the majority of the government assistance programs that provided payments have now come to an end. Citi is one of many significant investment institutions to express confidence that the inflation we are experiencing today is only transitory. Unfortunately, there are also good grounds to think that the high inflation we are currently experiencing won't be subsiding anytime soon. As more isolated, slower-moving categories like rent join the trend of price hikes, the claim that price increases are only limited to industries impacted by pandemics is starting to falter a little. Another issue is the situation of the labor market. Rising unemployment rates and trouble filling positions may result in higher salaries. Larger salaries may encourage recipients to spend more and urge firms to pass along these costs by raising pricing. These findings, along with the probability that it will take longer than expected to resolve the supply chain constraints brought on by COVID-19, suggest that we could be in a significantly worse situation this time next year. The Fed's view. The individuals in charge of ensuring stable price growth have remained pretty composed amidst all this worry. The Fed has stated that this recent spike in inflation is natural and simply a byproduct of the economy returning to normal, after a rather substantial, unheard-of downturn. The calm words made by central bankers shouldn't come as a huge surprise. Their role is to maintain calm, prevent panic in the markets, and only act or change course when absolutely necessary. Reduced purchases of Treasury securities and mortgage-backed securities, MBS, which have been crucial in maintaining interest rates at record low levels, have been the sole major action to date. The Fed has additional instruments at its disposal to boost borrowing costs and deter spending if that play is not enough to cool the economy down. Inflation winners and losers. As long as it is kept under control, a little inflation is both required to keep the economy expanding and generally regarded as healthy. If costs keep rising too quickly, it will become a problem that needs to be addressed. Rapid inflation can get very ugly, and it usually results in businesses and families cutting back on spending and eventually entering a recession. What causes inflation? Price increases for goods and services, or inflation, can result from a variety of factors. Generally speaking, it occurs when there is an imbalance between supply and demand, or, to put it another way, when there is too much money chasing too few goods and services. What is the most common measure of inflation? The most commonly used inflation indicator is the Consumer Price Index, CPI. The Bureau of Labor Statistics, BLS, produced the data, which is then used to compare current pricing trends to those from a previous time period. It monitors price changes for a basket of frequently purchased products and services. Investors may find it beneficial to monitor the CPI because it is one of the instruments that central banks use to determine interest rates. What is the predicted inflation rate for 2022? Depending on who you ask, yes. Various experts have different predictions for the rate of price increases during 2022. While some analysts are optimistic that inflation will decline toward the Fed's 2% goal rate, others think it may continue to rise unless more active steps are taken to raise historically low interest rates. What is the relationship between interest rates and inflation? Interest rates are a useful tool for central banks to manage the cost of money. Low borrowing costs tend to increase consumer and company spending. This activity typically results in inflation, which can be prevented by raising interest rates sufficiently to encourage saving. Thank you for watching this video. If you like this video, don't forget to hit the like button and subscribe to the channel so that you don't miss out on our upcoming videos.